Today on the show, I have the pleasure of speaking with Jilliene Helman. Now, Jilliene is the founder and CEO of Realty Mogul, one of the top online marketplaces for investors to invest in institutional quality real estate here in the United States. Now, Realty Mogul was recently named the #1 real estate commercial crowdfunding platform by Motley. And to date, get this, investors have invested in over 300 unique transactions and over $3 billion of capital has been raised on the Realty Mogul platform. Jilliene has also been featured as an expert on startups and real estate alike on Bloomberg, CNBC, the New York Times, Yahoo Finance, and Entrepreneur.com. To say I'm a little bit excited to have her on the show today is an understatement. G'day, Jilliene. Welcome to the show. How are you doing today?
Thanks so much, Reed. Excited to be on with you.
It's awesome to have you. And I want to start the conversation like I start every episode. Rewind the clock and tell me how you made your first ever dollar as a kid.
This one's kind of embarrassing, but I love the question. So I was an extra in a Ken Griffey Jr. baseball commercial. And that was the first, I got paid to be an extra. I mean, who could believe it? I was probably like, I don't know, 5 or 6 years old. Why I was an extra on a Ken Griffey Jr. baseball commercial, I have no idea. And that was my only foray into the acting world. But that is how I made my first ever dollar, was an extra on a commercial.
Well, I will say that is the most interesting response I've ever had. Everyone's like mowing lawns and selling lemonade. And I'm just like, yeah, who cares? Like, if you say lemonade or lawns, I'd be like, okay, the show's over. But no, that's incredible. So you're an extra in an ad. Were your parents involved in the Hollywood scene to?
No, not at all. I think that like one of my close friends got asked to do it and then asked if she could bring me along, and then they threw me in the scene. It was something like that. So very random. And, you know, I'm not a childhood movie star by any stretch of the imagination. I can't even find the commercial. In my adult life, I've never even seen it. So if someone wants to try and find it and dig it up and send it to me, I'd love it. But I don't actually know, where it is out in the ether.
That's a challenge. I think that's a challenge for people to get over and start Googling. But that's an incredible story. But now walk us through how you've created. Now, for me personally, I know Realty Mogul really, really well. It's been one of the early adopters of crowdfunding. But I want to know the story before Realty Mogul. How did you get involved in wanting to be your own CEO, your own entrepreneur? Did you have a career beforehand? What was that like for Jilliene Helman?
Yeah, I grew up in a very entrepreneurial family. So my dad's an entrepreneur. My mom had entrepreneurial, business pursuits. I have multiple siblings who are CEOs of, their own companies and their own endeavors. And so I really learned about business like at the dinner table. I'm the youngest in my family. I'm the youngest of 7. So I have 6 brothers and sisters, and we talked a lot. We talked a lot about business. My dad would come home and talk about what was going on with his company. And I always knew that I wanted to do something, in business. I went to business school at Georgetown, came out of there, and I went to work in banking. So my first career kind of before Realty Mogul was in banking, worked in strategic planning, worked in marketing, but spent the majority of my time in wealth management. So working for, wealth management firm, working with high net worth individual clients in addition to some nonprofits and endowments. And, the wealthiest clients were real estate investors. And I'd grown up in a real estate family. My grandfather developed property in Los Angeles. My mother was in luxury residential real estate. And my father owned commercial and office real estate through his businesses. So I knew about real estate, kind of going back to the dinner table, and found that our wealthiest clients were real estate investors. Always had a passion for real estate. And so when the Jobs Act came out in 2012, and I read through sort of crowdfunding, which was the first change to the securities laws in, decades upon decades upon decades, I didn't want to apply to startups. I didn't want to apply to small businesses, but I thought, could you apply this to real estate? And when I got sort of the answer on the regulatory front of, yeah, you could, there's nothing limiting your ability to do that, I quit my day job and I launched Realty Mogul in earnest.
That is awesome. I will say, poor mum and dad, 7 kids, that's a lot. That would have been growing up in a household full of mayhem. I've got friends who've got 4 kids. I'm like, geez, you're outnumbered already at 3. So seven would have been nuts. But let's talk about the Jobs Act, because I've had a lot of people on here talking about crowdfunding. And as an outsider, right, I'm just going to put my hand up. Sitting in 2021, so 9 years later since the Jobs Act, when I first moved to the United States, I saw a lot of come to market, you guys who are like, we're going to raise money and be real estate crowdfunding. I feel as if a lot of those pretenders have gone away, but yet Realty Mogul has seemed to have stayed the distance. Why is that? And how, maybe you want to talk a little bit about how you've stayed the distance with so much turbulence in and around online crowdfunding.
Yeah, I think in general, people struggle with a long-term mindset. It takes a lot of self-discipline to have sort of that long-term mindset. And only today, almost 10 years in, do I feel like we've got a lot of it figured out. But it took a very long period of time. I mean, the challenging thing, it's a dual-sided marketplace. So just taking a step back outside of real estate, anytime you're trying to build a business that's a dual-sided marketplace, you're building two businesses and you have to build them at the exact same time for the main business to work. Right. And so I was incredibly naive when I started the business. Knowing what I know now, I would never build a two-sided marketplace. I would go build, one product, one company, one customer, because it's really double the effort and double the work and double the failure rate. Right. And so I'm not surprised that a lot of companies that try to jump into this business have struggled to, complete their destiny, if you will. So you're building two businesses at once. On one side of the marketplace, we've got these real estate companies. They come to us and they use the Realty Mogul marketplace to raise capital for their deals. On the other side of the marketplace, we've got a very vast network of investors who are coming to the Realty Mogul marketplace to find, vetted, underwritten commercial real estate transactions. And we're the marketplace sitting in the middle in between those two constituents. And so you had to build two businesses at once. And I think that that's a big part of it is it takes a long time. It takes a lot of energy. It takes a lot of effort. It takes a lot of focus. We as a business have continued to just narrow our focus. In the early days, we had a lending business and an equity business. We decided that we couldn't be the best in the country at lending. And so we ended up selling that business in 2015. And we said, but we can be the best in the country at, medium balance or small balance equity. And so that's really what we're focused on today is allowing investors to gain access to equity investments in real estate and narrowing that focus. And I think there's other companies that didn't narrow that focus and just weren't patient enough. In the early days, almost 10 years ago, it was scary to invest on the internet. People weren't comfortable putting their banking credentials on a, website that maybe they'd heard about one or two times. And it's a different world today, and I think COVID helped to accelerate that and that we're all working out of home offices. You're not sitting in front of your wealth manager. You're not, meeting in person and sort of whining and dining the old fashioned way. And so people have had to get more comfortable investing online and, using digital platforms and using digital credentials and all of those types of things. But it's taken a long time for the market to catch up. And I think that, companies like ours who have said, we're going to take a long view, it's not a race to the finish line. Let's build a great business. Let's do it slow and steady. This is a life's endeavor for me, right? It's not a blip on the radar. I mean, I think that this is the biggest company that I will ever have the pleasure of being involved with, and certainly that I'll have the pleasure of leading. And so I've got a long-term perspective. And I think that, that set us apart in the early days. And, again, now almost 10 years in, we've got a lot more predictability around the business. And it feels like we're in a really, really great place.
And you bring up a couple of, I was jotting down some notes here. And I think one of the big things that has helped with the long-term mindset is brand recognition, right? I think that you mentioned the attracting of the investors. And I've had a few other CEOs on this show about crowdfunding who essentially, it's like you're a marketing agency, right? You have to build the trust with those investors because like you said, historically, you haven't been cruising around on the internet at midnight, here's a $100,000 investment I'm just going to make, into a Class B multifamily in Texas. You're not just going to do that. And changing that mindset, I think, has been at least from an outsider's perspective, and interviewing a couple of the CEOs, been the hardest part, right? Trying to get that. So how have you broken down that outward-facing trust for people to say, I want to be and invest with Realty Mogul and the deals that they put on their platform?
Yeah, I think in response to that, I would start with saying we are in no way, shape, or form a marketing agency. So we are as far from being a marketing agency in how we operate and our culture and our core values than you could possibly imagine. And I think that, this may sound sort of corny, but I think that it starts with culture. Our second most important core value is protect the investor. And that means that we do due diligence on all of our offerings. We're running background checks and criminal checks and reference checks. Most of our clients, not all of them, but most of them, I have a personal relationship with. I've broken bread with them. I know them through, other networks like YPO or other real estate networks. We also have another core value that's details matter. We dive into the details and we walk every property. We actually fly to the properties, even during COVID, masks in tow, to be able to look at the property, look at the location. We vet the pro forma numbers. We dig into the Excel files. And then our number one core value is sleep well at night. And that is for our team, for our investors, for our sponsors, call it karma, call it doing the right thing. So I think that, our ability to get investors to trust us is because we're trustworthy, not because we're a good marketing agency, right? And obviously we have to have marketing and we spend money on digital ads and all the like. I mean, that's just the basics to build a business today. But I think that it comes down to we're trustworthy, right? And that doesn't mean that every investment performs at 100% of where you expect it to. What it means is that if there's something going awry, we're going to tell you about it. Right. We're not going to hide under the covers, right? We're the company that we believe in open and straightforward and transparent communication. I tell my team, if you're delivering good news, go ahead and use email. If you're delivering bad news, do it in person, right? And it's been more challenging, obviously, during COVID, but we're not afraid to have those conversations. And so I'd say we earn the trust of people by being trustworthy.
No, I completely agree with that, and I think what my sentiment was talking about in the early days, trying to educate people in a way using marketing to say this is what the new future is, because so many people were coming away from that mano a mano, breaking bread. This is how deals are done. This is how real estate's done, and then bringing it to an online platform was like what? 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 That makes no sense. So when I say marketing, I meant more like educating the consumer to be more at ease with the process of investing online rather than the mano a mano, which has historically been. What has been some of the challenges of starting, being a CEO of a crowdfunding platform over the last 10 years, looking back? What do you think has been the number one or a handful of challenges that you have faced and come out the other side okay?
Yeah, I think the biggest challenge, it kind of relates back to what I was sharing earlier of you're building two businesses at the same time. And so keeping supply and demand in balance is very, very hard. Even today, nearly 10 years later, it's very challenging because you've got reputational risk on both sides, right? When investors come to the marketplace, you want there to be high quality product, but we don't want to put up, transactions that we haven't vetted and that we don't think are high quality. And then on the flip side, when real estate companies come to us to use the marketplace, we need to make sure that we have enough investors. Right. And so it's how do we grow the relationships with the real estate companies at the same speed as the relationships with investors? And you kind of got to just grow them both like this very, very slowly. You can't leapfrog one, because if you leapfrog one, you're going to lose the trust of the other side. And so it's been very, very hard, and that comes down to all kinds of decisions. It comes down to how much money do we spend on marketing? Who do we hire and what departments are we hiring in? How do we capitalize the parent company? How do we think about using our own balance sheet to capitalize transactions to make sure that our sponsors have certainty of capital. And so I'd say that's been really challenging. And it's still challenging today. And we just try and do the best that we can. And again, it goes back to being really transparent and upfront with people, right? And if that's on the investor side, I'll give you an example. We never used to do development transactions. So prior to COVID, we really felt like it was not the right time to do development because we were worried about there being another downturn. And when you get caught, in another downturn with a development transaction, it's not a good thing. And we felt like we really had to protect investors and really just said, we're not going to do any development on the platform. Now, post-COVID, we actually are pretty bullish on development from an investment thesis perspective because we believe that there's going to be less properties that get built and that properties that deliver, late 2022, early 2023 are going to have strong absorption kind of coming out of COVID and sort of the resurgence of the economy. And so there's been an educational process there with investors of look, these are riskier deals, right? We're allowing them on the marketplace. We're working with people that we think are high quality. We're still walking the land and making sure that, we believe in those locations, but they're higher risk, right? You're not suddenly having the potential to earn double-digit returns with less risk. That's just not the reality. And so there's been a huge educational piece around that. And that's been challenging too, right? To be able to be sort of the voice of the investor and do that in a way that treats the investors as smart, intelligent decision makers, which they are, right? Our investors are incredibly sophisticated. They're incredibly smart. And we want to also be a gatekeeper to make sure that they're not even seeing stuff that they shouldn't waste their time on. Right. And so that's been a hard balance to play because the reality is when you have, we've got 220,000 investors on the database today, right? There are plenty of people in that database that can and should be investing in development deals because that is a fit for their risk profile. And there are plenty of people in that database that never should touch a development deal because it's not appropriate for their risk profile. And they have to make that decision, right? We don't make that decision for them. We're not their investment advisor. They really have to make that decision themselves. But what we can do and what we feel very strongly about doing is educating them, right? And educating them on what are the risks and is this the appropriate risk for, my investment profile? And they have to make the ultimate decision. But that's been challenging too, kind of playing that middle ground, if you will, of what's appropriate, what's not appropriate when the database gets so big that there's a subset of people that it's totally appropriate for and a subset of other people that it's totally inappropriate for.
And I completely agree with that. You have to split the herd up of who is going to be in certain deals and who won't be in certain deals. My question to you next is given what you've seen over the last 10 years with, you've vetted a lot of deals. Obviously, deals have started, particularly in the historical multifamily space, deals are starting to get thinner and return expectations have to adjust. How have you been able to educate people, particularly your 220,000 people, about those return expectations as cap rates compress, as things get tighter, and more people come in essentially into the market, money's flooding the market, that causes things to be more expensive?
Yeah, it's hard. I mean, at the end of the day, it's supply and demand, right? Like we can't manufacture something that doesn't exist, right? And so we're just honest about it. We're transparent about, the underwriting. Our sponsors who work with us to post transactions on the platform, they share their financial models, right? And investors have the ability to dig into those. We host webinars so they can ask questions of the sponsors. They can talk about the transactions. And we're writing thought leadership pieces, right? About what's going on in the world, what the impact of inflation is, what the macroeconomic risks are, what the micro market dynamics are. So there's, a lot of education and, there's some investors who are going to opt out of investing, right? There's investors, I think you're going to ask me later about like a mistake, but a funny mistake that maybe isn't funny, but is in 2012 when we started the company, we should have bought everything. Right? We should have had like no credit standards and no underwriting standards because we would have looked like geniuses today, right? But that's not our culture. That's not how we're wired. That's not how we're operated. But like that was a very big missed opportunity, right? Because I think that the 2012, 2013, 2014, 2015, 2016, 2017, 2018 vintages are like incredible real estate, right? At least in today's markets, given how cap rates have compressed, assuming you put, the right debt on it and you execute well. And so I think that, that's just the reality is we try and educate people. Some people are going to opt out. Some people are going to opt in. We've got folks who, made multifamily investments with us from 2012 on, and now they're only investing in, office, retail, and industrial deals because they feel like the cap rates have compressed to a place that they're not comfortable. We've got other people who, are investing in multifamily deals where 2 years ago that may have been a 16 or 17% projected return, and today it's a 14, 15, and they're comfortable with that, right? Because they think to themselves, where else am I going to potentially make, 13 or 14, 15% in a risk-adjusted place like multifamily? I mean, I still believe multifamily is one of the best risk-adjusted returns in the market, even though cap rates have compressed, returns are coming down. I don't know that I expect in my lifetime, though, to see the kind of vintage like the 2012, 13, 14 vintages. Like, I don't know that comes around again. And so you have to ask yourself, do I sit on the sidelines? What's the opportunity cost of my money just sitting in cash? Or am I comfortable with lower returns because the risk profile has gone down? And the risk profile has gone down because there's more capital in the market, and so there's more liquidity in the market. And you just have to weigh that, and that's kind of up to each individual investor to make their own decision.
No, you bring up a really good point of that compressing return, and people. I talk to a lot of investors, and some of them not so educated, but not so much. But they're having this fantasy that it's got to return to those days of 6-7% cap rates in multifamily. And I know we're going to talk about something you're really passionate in a minute, but with again back to supply and demand, when the housing crisis in the United States and across the world, there's a housing crisis in most Western countries, that we can't build it fast enough at affordable rates. That it's still very, very attractive for the person who is renting, and thus, as you talk about risk-adjusted returns, it's still a good return at 12 to 14% compared to where you were maybe 16, 17, 18%. And I think there's just been a big shock in the average retail investor, at least in my experience, to try and recalibrate that and still think this is a good return, and I understand why. And I think that's, as an operator myself, as someone who's constantly communicating with investors, making sure that they understand the why behind it. It's not just this is a more riskier deal because the returns are lower, and then being transparent. So, but with that being said, we're talking about affordable multifamily, affordable housing, I should say. In the green room before we press record, you mentioned some of your biggest passions are affordable housing. So do you want us to maybe start from the top for those people who aren't as familiar with what's going on in the United States today, with who aren't struggling to keep a roof over their head, but what are the factors affecting affordable housing and how we can make it better? If you have any thoughts on that, because it's obviously a big question.
Yeah. I mean, look, I guess just taking a step back, it's really more of an emotional one than a financial one. But like, I can never imagine not having a roof over my head, right? And the homelessness situation in our country has just gotten so atrocious. I everywhere I go, I see people who don't have a roof over their head. And it just like makes me sad. If you just call it out emotionally, it makes me very sad. And so I've gotten very passionate about affordable housing. In addition, financially, I think it's a great financial instrument, right? I think that they're not making any more affordable housing. It doesn't make sense to build, right? So if you're going to build, you're going to build Class A because you look at the cost of land, the cost of construction, the cost of raw materials like lumber, and you just can't build affordable housing without subsidies, right? Without tax abatements, without subsidies from the government, without, a church donating land as an example, which is a deal that we saw recently. But I just fundamentally believe that people deserve a roof over their heads, right? And so I feel passionate about that, and I feel passionate about it being a good risk-adjusted return for investors as well. We actually, in investment committee, I just came straight from investment committee into this meeting, and we were talking about an affordable deal. It's an affordable deal in Dallas, under Allura, built in 2005. And, our CEO, we were debating the pros and cons of it, and our CIO said, the one thing I can tell you about this property is that rents are never going to go down. And I can't say that of many properties, right? Of market rate properties. And and we've got, analysts on that and people that we're training up. And so we try and have kind of really robust conversations. We use it as a training ground in addition to just a ground of like talking, very deeply about deals. And it's true, right? Like rental rates are not going to go down in affordable housing projects, right? Because there's nowhere for them to go, right? There's nowhere for these people to go. There's just not enough supply in the market. And that's sad. Right? Because we really should be able to take care of people who can't take care of themselves, or at least I believe that we should. And how you do that, I don't want to get in the political conversation, right? This isn't necessarily that there's a lot of different ways to fund it and to think about it, whether that's, private capital or public capital or otherwise. But I do find that, we've got a very wide divide between the haves and the have-nots in this country. And for those of us that are fortunate enough to, be able to help, I think that we should be helping. And so, I'm a big proponent of affordable housing, both from the emotional side and the financial side.
And what are you doing with Realty Mogul besides obviously just offering the more affordable projects on the platform? Is there anything else that you're looking into in terms of being a thought leader, being a platform where people can invest in, going back to that education piece, to sort of combine the emotion with the financial? Yeah,
look, the financial side drives it, right? For better or worse, like money talks in our country. And so it's this belief of like, let's finance and fund affordable housing. Because if you can create more liquidity there, you can create more demand from the financial markets, and that helps, right? And so I think that, there are platforms that will say, oh, no, we're not going to do affordable housing, or we don't believe in it, and we really deeply believe in it. So I think that we're trying to make an impact from the financial side to also destigmatize affordable housing. Right. And there's a lot of affordable housing across the country where you have sort of these slumlords, right? I won't go into an affordable housing deal where the business plan is to be a slumlords, right? We've done other affordable housing deals where we're building pools, we're building parks, we're building playgrounds, we're partnering with nonprofits to do resume training. We're putting in, free for the resident childcare so that they can work, a full workday when their kids are out of school, and sort of have coverage between that 2:30 and 5 o'clock or 6 o'clock range. And so we've done and invested in a lot of projects like that, and I'm really, really proud of that. We run 2 public real estate investment trusts, and one of the independent board directors on our multifamily value add REIT is a woman named Flynn, and she's the CEO of a nonprofit that provides services for affordable housing. So they do a lot of those services that I just described, and we're really proud of that. We're really happy to be in partnership with her. And so we're trying to help where we can, but look, where we can is financially. We can fund these transactions, right? Because that's the business model and that's what we do. And, we're not going to fund a deal just because it's an affordable housing deal. That's not how we operate, right? If we go back to our core values, protect the investor is our core value. But at the end of the day, we think they're good financial instruments. We think we can help create additional liquidity. And through that and through CapEx budgets, we can make these properties nicer to live, right? And a safe place. I mean, we've, looked at deals and done deals where, there's been shootings on the property, right? And you need security, and you need to put fences up, and you need to put gating up, and you need to make it a safe place for people to live. And so we've, converted a lot of properties from places that I would say are, unsafe to safe, right? And I'm really, really proud of that. And that's part of the CapEx budget. And again, that's accretive to the project. That's accretive financially. That is good for investors. But at the same time, we're helping to, change lives. And that's what could be better than that, right? Make money and change lives. That's pretty cool.
Couldn't have said it better myself. So with your crystal ball, looking back at 2012 and you're kicking yourself, you should have bought everything under the sun. What's your crystal ball telling you moving forward in the next 10 years, or even short term in where we're at with interest rates and cap rates and all that sort of stuff?
One of the key lessons that I learned again during COVID is the lesson of the micro market. And so I don't have a macro crystal ball, right? And what I mean by the lesson of the macro or the micro market rather is like different markets perform totally differently during COVID. You take a market like Utah where you actually had unemployment go down during COVID, right? And you take a market like New Jersey where unemployment, skyrocketed during COVID, right? And then you look at the micro markets in between all of those markets and there's all kinds of craziness, right? You look at what's going on in, Dallas, Texas right now where there's huge population growth, tons of companies that are coming in and saying, that they're moving their headquarters there. And so you would think instinctually I should go buy office in Dallas. Well, we think office is oversupplied in Dallas. So we're not buying office in Dallas, right? And so there's all of these micro market considerations to be had. And so I don't have a macroeconomic crystal ball, but I think that the micro crystal ball is try and de-risk deals in any way, shape, or form that you can, right? And one of the ways to do that today is to lock in interest rates. We did deals, 3-4 years ago where, we locked interest rates in the 4s. Today, that interest rate would be, 3%, 3.20, and that was not the wrong decision, right? I'm not kicking myself that was the wrong decision because that's what we underwrote. It underwrote to good financial returns, and we de-risked it, right? At the time, we thought that interest rates were relatively low. Now, in hindsight, that was, not the right call, but it was the right call, right? Because of kind of that de-risking. So when I talk about de-risking, it's look at the supply and demand in the micro market. I'll give you another example. Tampa's hot, Florida's hot. We like Tampa a lot. And yet the new starts on new Class A multifamily are concerning to me, right? And I don't want to own 2010 product in Tampa right now because that's going to compete with this onslaught of new product and that could push rates down. Now, we're looking at a deal in Tampa right now that's 1984 vintage. I like that vintage. And there's no amount of new product that is going to impact the rental rates on 1984 vintage because it's a totally different tenant base, right? And so as you start to de-risk, it's really understand the micro market, supply and demand of the micro market, the impact of financing, right? And it's not to say on the financing side that we won't use bridge debt and floating rate debt. We do a lot of deals with bridge debt and floating rate debt because we think that makes the most sense for the business plan. But there's a key decision to be made of when do you go refinance that? Do you refinance at month 24 because the renovations are done? Do you hold on until, month 36 until every renovation is done? Do you hold on even further until month, 48? In general, I'd rather de-risk the interest rate risk sooner. So, refi closer to month 24 than month 48. In general, again, it's sort of, you have to depend on the micro market. But that's what my crystal ball is, just try and de-risk by looking at the micro fundamentals and not the macro fundamentals, because I think that you get very lost today if you look at the macro. And there's so much nuance in real estate across markets.
I completely agree. One of the big things that I learned when I first moved to the United States, particularly coming out of 2008, was the US, and this is as an international Australian reading the news, the US housing market, right? And the first thing I realized when I moved to the United States, there's over 400 MSAs in the United States. And within each MSA, there's a north, south, east, west, good side of the tracks, bad side of the tracks. And it was just so up to surface level. They were just blanketing the US housing market's the issue, right? But yet you look at some economies, some markets that were completely unaffected, like Austin, Texas, coming out of 2008. It goes back to your point of you have to be, real estate is local and you have to understand the local trends and what's happening in those exact markets, because also the United States is the behemoth of commercial yielding product when you compare it to other yields across other Western countries. You compare it to Sydney, you compare it to Hong Kong, you compare it to Europe, you do not get the same yields as you do in this country. And that's I won't even get into that. But it's just so important to not lose sight of that. And then, but obviously coupling, I did exactly the same thing on my first ever 2 deals. 4.35%. I thought that was a smoking deal. Freddie fix for 7 years. I'm kicking myself. I could have sold that deal 3 times over by now, right? But, at the time, you did what the best we thought things were going to the moon. So I sympathize with you on terms of having that incredible grounded approach and understanding, like your example of Tampa versus, say, Utah versus New Jersey. So really, really like that. I guess as we come to the end of the show, what is the future for Realty Mogul moving forward? What's the future for yourself personally moving forward? And where do you see the company in 10 years' time?
Yeah, we're going to continue doing what we're doing. We're slow and steady. Hopefully there's no surprises, right? Like if we're doing a good job, we're just going to continue to keep growing and, provide strong risk-adjusted return transactions to investors and work with great operating partners and, be in the real estate business. You have to stay in the game, right? You have to do deals. You have to keep educating yourself. And so we don't have some, grand plan to change the company or revolutionize the company. I mean, we're on the cutting edge. I think we're doing a great job. There's always room for improvement. We just want to keep doing what we're doing, which is sourcing, great deals, working with great partners, and making sure that we're communicating and being trusted by investors.
One last question I have for you, and this is just more of a personal question, is do you see, I guess maybe I'm answering my own question, but do you see investors going around you in the future and going directly to sponsors? Is that a risk for Realty Mogul at some point in the future?
Look, my belief is that you have to earn the respect of people, sure, right? And so if we're not doing a good job, well, then who am I to say that they shouldn't go around us, right? Mm-hmm. And so I look back at that and it's like, build a great business, do what you say you're going to do, provide the asset management services and the administrative services that we say that we're going to do. And I think that investors are willing to pay for that, mm-hmm. and we've had so many examples of, where we've stepped in, and some of it's silly, right? Some of it is, they didn't do the K1 right? And there was going to be implications 2 or 3 years down the road, right? And we caught that and we provided that. Some of it is, we'll force a sale of an asset because we see supply and demand characteristics differently than a partner, right? Some of it is we're going to look through the financials and we're going to do an assessment of where the property is performing and give them these really nice, pretty concise, recaps, right? And investors, so different investors are willing to, pay for different things. But I think that at the end of the day, like if we do a good job, there's room for us. If we don't do a good job, there's not, and there shouldn't be. And I'm perfectly okay with that. And I'm looking to run and build and continue running and building an organization where we provide a meaningful service, right? And we provide a place where investors can trust what they're seeing. And investors, albeit, they still have to do their own due diligence. We don't know if it's appropriate, for their risk profile, for where they're at in their lives, all of those types of things. If they have, 7 kids or no kids and discretionary income or no discretionary income, that's not our position to say whether the deal is an appropriate deal for them. But again, I think if we do a nice job, that they won't. And if we don't do a nice job, then they will.
Very self-aware answer. I like it. Look, Jilliene, at the end of every show, we like to go into the lightning round of the top 5 investing tips. You ready to get into it?
Sure.
What is the number one habit you practice to keep on track towards your goals?
On track. I don't know that it's on track towards my goals, but I would say that probably one of the most influential habits in my life is my gratitude practice. So every day before I go to bed, 3 things I'm grateful for. Every day when I wake up, 3 things that I'm grateful for. And it's really changed the myelin in my brain. Like that may sound kind of quirky and a little crazy, but like it has genuinely changed my brain. And it's probably like the single most important daily habit that I do for myself that allows me to, be in a place where I can even have goals.
That's awesome. No, I think it's super important to be grateful and mindfulness and having a little bit of stillness in the morning of just before the rush of the day. So awesome stuff. Question number 2, who's been the most influential person in your career to date?
It's probably my dad. My dad has always been a key sort of mentor to me and someone that I've looked up to. He's run businesses since he was in his early 20s, didn't graduate college, very entrepreneurial, and has been just a great professional and CEO and business owner in addition to a great father. And so I look up to him immensely.
That's awesome. Well done, Dad. Question number 3 is, what's the most influential tool in your business? When I say tool, it could be a physical tool like a phone or a journal, or it could be a piece of software that you can't run the business without. What is it?
I don't know, maybe strange answer, but I think it's my ears. I think it's listening, and like taking the time to listen and to seek input and to make sure that my team feels heard and to talk through deals. I mean, sometimes, our CIO and I will like sit on the phone together for 2 hours and just talk through deals. What are the risks? What happens if this happens? What happens if that happens? What's going on in this micro market? What are the crime stats? It's just listening and being willing, to learn and to listen.
That's awesome.
Maybe a corny answer. But
no, corny, but I like it. Question number 4. In one sentence, what has been the biggest, I don't want to say failure, or mistake or lesson that you've learned in your career? And what did you learn from that mistake or failure?
I mean, not investing more early on was probably the biggest one for us, to be totally honest. I mean, I look back now and it's like, we would have been such a different company if we, had moved faster and we put out more capital. And I was cautious, right? So I guess the lesson is be less cautious, although I'm not really wired that way.
You don't strike me like that.
I think it's just have more confidence, when there's an investment thesis that we believe in, like go for it, right? Because at the end of the day, you still own physical real estate, and I think that as long as you have staying power and you can hold long term, I'm a big believer in real estate, over the long term.
But I think it also, the other side of the coin is help you become disciplined, right? In terms of your approach to real estate. So maybe some of the practices are, the other side is like, we now develop the systems we have to be more bullish because we know more, right? So awesome stuff. Last question, where can people reach you to continue the conversation? They want to be in your circle. Where do they go?
Yeah, I mean, sign up at RealtyMogul.com. If you're not, it's free to sign up. And once you become a member, you'll start getting our flow of real estate transactions. And so those are always fun. If you're ready to invest now, great. If not, be a watcher and learn. I've had, so many young people reach out to me and say, I just signed up for Realty Mogul and I see your deals. And like, I've learned so much of looking at real deals and watching real webinars and like being in the conversation. Also feel free to reach out on LinkedIn. You can just type my name and let me know that you heard me on Reed's podcast, and would be happy to connect and go from there.
Awesome. Well, look, I want to thank you so much for jumping on the show today. I just want to reflect some of the things that I took away from today's show. I think the big thing for me was you're building 2 businesses with the crowdfunding platform. I think it's such a, as you said it so simply, but it is so true. It's 2 facing sides of the coin. But for me, narrow your focus, details matter, and sleep well at night. The 3 core messages, which we all as owners and operators want to do, right? I myself have gray hair from maybe not sleeping well at night because you're thinking about stuff that can go wrong. But running a business and having a good culture like that helps you build that brand recognition and helps people come back and having repeat business and put you at the pinnacle of the crowdfunding industry. So that's what I took away. Well done. Did I leave anything out?
No, I appreciate it.
That's awesome. Well, look, again, thank you so much for jumping on the show today. Enjoy the rest of your week and we'll catch up very, very soon.
Thanks so much. Take care.
Well, there you have another cracking episode jam-packed with some incredible advice from Jilliene. If you do want to check out their stuff, remember, head over to RealtyMogul.com. Reach out to them. They've got so many incredible deals on their platform right now, and hopefully this interview is giving you a little bit of insight about how they go and vet those deals. I want to thank you all again for taking some time out of your day to tune in to continue to grow your financial IQ, because that's what we're all about here on this show. If you do like this show, the easiest way to give back is to give it a 5-star review on iTunes. And we're going to do this all again next week. So remember, be bold, be brave, and go give life a crack.